Hello and welcome to another episode of Nothing Ventured with me, Aarish Shah. Today in the studio with me I have Rajan Dosanjh and Ankush Shah. Rajan and Ankush are partners at Rank Ventures, a dynamic firm connecting the dots to help companies scale, deploying with significant skin in the game. Rajan brings over 2 decades of expertise in structured finance and trading, having held leadership roles at institutions like Société Générale and Evolution Securities. His portfolio includes board roles at Edify, Exxon and other ventures. Ankush complements this with a vast background as an investor and operator, with board positions spanning sectors from AI to renewable energy. He is a managing director of the Samaria Group and chairman of DoughWorks, overseeing major food and beverage franchises in Africa and the UK. Ankush's unique perspective blends deep operational insight with a passion for fostering entrepreneurship in tech-driven businesses. Together, Rajan and Ankush are reshaping the investment landscape by using their experience first as operators and angels and translating that into a focused approach to investing in ventures, building significant businesses. In today's episode, we talk about how banking is eat what you kill, whilst venture is eat what you grow.
Banking is eat what you kill. It's very much centered around wealth extraction or value extraction. I like to believe that venture is about eat what you grow.
How you should be playing indefinitely repeated games.
We play indefinitely repeated games. These are not one-shot games that we play.
How Rank focuses on making the pie bigger for everyone, and how it isn't here to fight, but to build.
We're not here to fight. We're here to build. We're here to grow.
How in 2026, you need to have a plan to get to profitability with the cash you have on hand, and intentions, actions, and consequences matter.
What was your intention behind that action?
And why, as board members, it is critical to remove blame culture.
The minute you see blame culture, you know there's a weakness.
And how 90% of the work that is done at the board meeting is actually done before it even begins.
90% of the work done at a board meeting is done before.
Let's get straight into it. Hey guys, whilst I've got you for a second, I just thought I would reintroduce myself. My name's Aarish. I am the host of Nothing Ventured, the podcast where I talk to the people behind the stories that make the venture ecosystem go round. I'm also the founder of Emerge One, a consultancy that provides fractional CFO support to venture-backed tech startups from seed to Series B and beyond. If you enjoy the podcast, we would love it if you could rate and subscribe wherever it is that you listen. And if you ever want to have a chat to me about anything that we've talked about on the pods, or even want to recommend a guest, do reach out to me on LinkedIn or X. I'm always up for a chat. Right, let's get straight back into it. Ankush, Rajan, really great to have you in the studio with me today. Thank you so much for joining. I think we said this is maybe 1, maybe even 2 years in the making. So very glad we managed to kind of lock you guys down and get in today.
Great to be here.
Yeah, thank you.
I mean, you've traipsed all the way in from Victoria, so yeah, we should make this a good one. But look, I've known you both for a pretty fairly long amount of time. But I would love for you guys to share your origin story, because you've come from very, very different backgrounds, as we heard in the quickfire earlier. Rajan spent a huge amount of time in the city, and Ankush, after leaving the city, took a very different route, spending almost 2 decades out in East Africa running businesses. So tell us how you came together and how you made the decision to ultimately build Rank.
Sure. So we were touching on this earlier. Rajan had told us about the company that he was involved with and co-founded. I had invested in it, actually largely because of Rajan, even though I didn't know him at the time. He's just a very credible guy, and he came across very well on the kind of 2 or 3 Zoom calls that I had.
I mean, I decided to work with you immediately, I think, after having spoken to you at that time. Like it was a 20-minute phone call, if that. But gelled immediately.
And so I'd made a kind of small angel investment in the company. And then what was it, Rajan? It must have been a year or so after that I was randomly driving home after dropping my kids at school. And I saw Rajan walking down the road, walking his dog Phoenix, who is a legend. By the way.
I was hoping he was going to be in the studio, but Rajan disappointed me today.
I had him groomed yesterday, especially as well.
And I just messaged Rajan afterwards, just saying, hey, saw you walking, snappy jacket, like the dog, whatever, right? Just saying hi. And Rajan said, Ankush, he replied back, Ankush, there's something I need to tell you. Can you come round
That sounds
to my office?
ominous, yeah.
Yep. Obviously, as an investor in a company, that sounds ominous, right? So I came round and then...
So basically, I'd founded this company, right? Brought in the right CEO, well, what I thought was the right CEO and the team, and was working with them. And I realized that actually, not only was it just the guy couldn't do the things that he claimed to be able to do, it was also the extent to which there was a widespread in moral compass and how people deserve to be treated, right? So, a big part of he is also an ex-investment banker, Lehman Brothers. Now, when people ask me to describe the contrast between banking and venture, what I like to say is banking is eat what you kill, right? It's very much centered around wealth extraction or value extraction, right? I like to believe that venture is about eat what you grow, right? And that goes not only through the product or what you're selling, but also the people and the people around you. So as you work with people, you're not using and eating and feeding off of those people, right? These are people that you want to grow with, right?
And so when I came to see Rajan, I think it's fair to say you were fairly upset at the time, right? The venture had not gone well. And at that time, I kind of had a choice, right? Here was Rajan handing me my EIS certificate saying, Ankush, I think you're probably going to need this because I think this is probably going to go to zero.
I think I wrote those EIS certificates.
quite possibly. I could see that he was not happy with the way things are going out. It affected him quite significantly.
Yeah.
And, many times in life you have a choice, right? Either you can kind of
walk away,
get pissed off and walk away or whatever, or you can lean in and embrace it. And I don't know. I saw in Rajan, similar values to myself. Integrity, do unto others as you would have done unto you. Treating people fairly, wanting to be able to hold your head up and look the people around you in the eye in future. We play indefinitely repeated games, right? These are not one-shot games that we play. And I recognize that in him. And so we bonded after that and started out as a friendship. We realized actually we have a similar way of looking at risk and reward, even though we have very different approaches and styles and quite different personalities as well. But those shared values and the similar sense of risk and reward, we'd both been making asymmetric upside or asymmetric bets in different markets, right, as parts of our careers. So we started investing together.
I just want to dig into that that whole point about asymmetric bets in different markets, because to my earlier point, you spent 15 years in Tanzania, right? Rajan, you've spent most of your life, all your life here in the city, right? And whilst Ankush, you had a banking background, right? Previously, you then went out and operated essentially, right? The common thread between both of you, and we're going to talk about this in a bit as well, but the common thread is kind of that you've both been investing in venture as angels, right? And I always say there's a very, very different mentality being an investor versus an operator. And in fact, you have to be quite careful of not conflating the two, right? Because sort of things you look at as an operator, which are fine as an operator, may not be the sort of things you want to look at as an investor, and vice versa, right? So had you already not gotten over, but had you already moved past that kind of operator mentality? And equally, I guess, how did the two of you gel given those quite very different sort of experiences?
So I actually started life as an investor.
Yeah.
So I was a hedge fund investor for quite a long time.
Yeah.
And that's really where I personally learned the craft of investing and this sense of risk and reward, and how to identify or how to know when you're facing a truly asymmetric risk reward. That was the whole nature of the event-driven investing world that I was in.
Yeah.
buying convertible bonds rather than equity because the downside is like 3%, but the upside might be a little bit less than the equity, all that kind of stuff, right? And moving into the operator role or roles, I said to myself very early on, actually in my career, that I never want to be a day-to-day CEO of a business.
Sure.
Right? I never want to be responsible for the day-to-day management of a business because I just don't think that that's where my skill set and my interests lie.
So you look at yourself more at board/ownership level.
Board ownership,
governance.
the guy behind the scenes who makes
Yeah,
stuff happen.
sure.
That's the role I've played in most of the businesses I've been involved with.
Yeah.
And
So then so Rajan, maybe to you, like, was that an attractive quality in Ankush that you either saw in yourself or saw as a gap in maybe your own experience?
I don't think I thought about it so clearly at the time. It was, I think it just sort of fell in place.
Yeah.
Right.
So it's just two people at the right place at the right time with a common, at that time, some common event that had kind of brought you back together.
It just felt natural, right?
Yeah.
Yeah. It just worked.
I mean, we've had guests on this. Like, we've had guests who literally, one of the stories was they took a like road trip through Zimbabwe or something, like two ladies, just driving across the desert or something bizarre like that. You didn't have one of those, like, I guess,
we had school runs to worry about.
Yeah, school runs or how to keep Phoenix in snacks. So finish off that story. So you because I interrupted obviously, but you find Rajan in the room. Having, being handed an EIS certificate.
Right.
Like, how does a conversation go from that to, over time, obviously, rank?
I think that's part of the journey, right?
Yeah.
So you start off at that place and you say, okay, things aren't going so well. What can we do about it?
Yeah.
Right. So you do the natural thing. You speak to who are then the VCs or the board of the company. And I guess through that experience, we sort of had, I'm trying to come up with the right words here to avoid getting sued. But
it's not only that situation, Rajan. In several situations that we've been in or seen, we've seen, fiduciaries, VC investors, people managing other people's money,
not acting as
who were
fiduciaries.
just not acting in a fiduciary manner, who are either turning a blind eye or just not even seeing what was happening or not being bothered to do something about it.
Which I think the three of us, I think, would all agree on over the last 10 years. I'm not saying that it happens as much as it has happened in the past, but certainly there was a period, maybe 2018 through 2022, where there was a lot of exuberance in the market, etc. There were a lot of people in venture that did not have those basic fiduciary skills. Right? They hadn't had that experience. They didn't know like what they should be doing on board. And we're going to come on to this in a second, but they weren't fit for purpose. I mean, I've had, instances where I've been told maybe, VC has rung up another VC and said, hey guys, we haven't received a balance sheet in the last few years. Is that normal? As a board member and stuff like that, right? So I mean, Ankush is coming out in hives. I can see immediately.
No, but Aarish, I would not say that that's restricted only to the world of VC and only to that time period, 2018 to 2022 that you mentioned. Like, we've been around long enough and been in enough industries, enough geographies to see it happening in, across the world, actually.
Yeah.
I've seen fiduciaries in Switzerland, like, piss away people's money to the tune of, like, almost $100 million.
Yeah, I know.
I think you're aware of that situation,
I think
right?
I know, yeah.
I've seen, people in Mozambique kidnap other business partners, and I've had to unfortunately try and be part of that hostage.
Negotiate the release. Yeah,
stuff like this happens all over the world.
Yeah,
and what really I think brought Rajan and I together in the realization that we needed to do something about it with Rank was we were seeing our friends and family, and to an extent us sometimes, being, not getting the best terms, right, not getting the best deals. but especially not having enough skin in the game.
Sure.
It not being a large enough ticket for us, for those people, our friends and family, to actually, protect their own interests.
Have trust that you are also protecting their interests.
Yeah,
as well.
and we're like we shouldn't have to put up with this, right?
Yeah.
We don't put up with it in our other businesses, right? If something's wrong in one of the businesses that I run or we control, like, we do something about it, right? We either change the team or bring in the right customer or whatever it might be, right? Why should it be the same in venture?
Yeah.
Right. Why shouldn't it be the same in venture?
Yeah. I think this. I mean, what this comes down to is really my next question, right? Which is, again, coming back to that question I posed earlier, the operator versus investor mentality, right? Because you've both been angels as well as operators, right? And you bring that mentality into the businesses that you invest in, right? So I guess explore further what that brings to the table and whether or not it brings, I guess, a different set of incentives as compared to a more institutional approach, right? Because you guys earlier, and we didn't talk about this in any depth, but you aren't a fund per se. You invest via syndicates, and as you said, Ankush, earlier, you guys invest, significantly. You have significant skin in the game yourselves, right? So, and do you think that your evolution from angels to running these sort of syndicates has changed your approach? And how do you think about investing other people's money? So, like a natural progression from what you were just talking about.
So, look, let me just. I think I can answer that question, but step back once, for a moment. So, I think the first thing is that as board members or as investors in a company, our approach is to make sure that the pie is as big as possible.
Absolutely.
For everyone, right? So we're not going into the room focused on what are we getting out of this, right? On many occasions we've expressed our views where it may not necessarily be the very best thing for our pocket at that time.
Yeah.
But we recognize that it's better for the health of the business or for everyone around the table to get a better outcome. And I think that's a real sort of clear differentiator in how we approach everything.
Yeah.
So how we work with our investors.
You don't play zero-sum games, essentially.
Yeah. So how do we work with our investors? We say to them, our co-investors in our syndicates, we're not going to eat. We're not taking anything out of this.
So you don't charge fees or anything
Correct,
like that?
right? Until there's a significant outcome for everyone around the table, right? I remember going, it's a silly example, but in my younger days, going to Thailand for a Thai boxing camp.
Nice.
And, you train hard, right? You've woken up 7 a.m., haven't eaten anything, bang, you're in the gym, smashing it up for 2 hours straight. You are hungry afterwards, right? And it's like a scene out of the movies. You're sat on a long dining table with benches. The food comes and it's just, fried rice with eggs and whatever. Steel plates just get handed out to everyone. The dish gets thrown straight into the middle, and it's whoever can eat the quickest and fastest gets to eat the most.
Gets the most, yeah.
Right? That's great, right? When you're all fighters, yeah. Well, we're not here to fight. We're here to build. We're here to grow. And when you're here to build and grow, you're there to check that the person next to you has enough on their plate as well as your own.
I think that's a lovely sentiment. I would argue that most people in venture would at least outwardly say that that's what they're doing. But equally, there are millions of stories out there of people being pushed out of allocations where they've introduced other investors into those deals. There is a what's mine is mine kind of mentality. Like obviously in a lot of venture, currently people are selling their own book, right? Like they are very, very much, obviously because venture, as with everything, but venture especially is a sales and a marketing game, right? And therefore the incentives and therefore the outcomes that those incentives drive may not be the appropriate outcomes, right? Like, and one of the arguments I have on this podcast a lot with a number of VCs, it's not even an argument because I think a lot of VCs are are thinking like this now is, yes, of course, venture is very much about power law and very, very concentrated outcomes amongst a few bets. But equally, there is this sort of middle tier of businesses that actually are good outcomes, right? They may be 100 million, 200 million, or maybe even less, or maybe even more, but they're not going to return the fund, but they're actually consequential outcomes, both for, certainly for the founders and the teams, and potentially for some of the early investors, maybe not the later stage investors as much. But often what venture does is drive those businesses to failure rather than actually taking that cash off the table when there is an appropriate exit route, right? And I think that's maybe what I'm hearing, certainly from what you're saying, Rajan, is that difference between being here not to fight but to build, right? Like, so how do we get to those sort of outcomes as well?
Yeah, absolutely. And if I can just pull on that thread a little bit, right? So, what we're doing at Rank Ventures is a natural extension of what we were already doing for ourselves, right? Individually and then collectively. And what that means is that we're not doing this as a job, right? We're not doing this as an asset gathering game. We're not doing this for the fees. We're not doing it like it's not paying us day to day, right? When we look at any particular company situation, we look at it on its own merits. It's not a case of, it's okay if these 10 fail and then this one returns twice the fund or 3 times the fund or 4 times the fund or whatever it might be, right?
You want to back all your babies to the same.
We do want to back all our babies. And we actually, look, I know a lot of people would say this, we actually do genuinely care about our founders, right? Like I have to tell Rajan regularly, like, to get off the phone with some of our founders at like 1 a.m. or whatever it is.
I've had those phone calls.
When he's like counseling them or, because I need him fresh the next day to like look at whatever else it is, right?
Yeah.
But we do genuinely care about our founders. We care about the outcomes that they make. It would distress me, and I'm sure Rajan as well, if any one of our companies did not accept a substantial outcome, $100 million, $200 million outcome for the founders, for ourselves, and for our investors, because it was being pushed to go for the $1 billion outcome.
Yeah, and I think that is, I mean, this is the dichotomy that we're actually in. I'm like, there are reams and reams of X posts and lots of thought leadership about like where is venture heading, and we've got this sort of bifurcation now where you have the mega funds just making like huge concentrated bets. Like, I did a news podcast last week, I guess, by the time that this pod goes up this week. And I can't remember the exact numbers, but it's something like, approximately 50% of all Q3 venture funding went into 18 companies, like 1/8.
Yeah.
Like that sort of concentration does not lead to good outcomes because concentrated bets rarely do, right? Because you're backing one pony. But B, it means that capital isn't flowing into potentially the businesses that could most utilize it, but also could be net beneficial across the board. And by beneficial, that could be beneficial to society, beneficial to the businesses that they sell to, or the customers the consumers that they maybe sell to, but also for investors, et cetera, et cetera. And I think there is a little bit, like certainly from my side, obviously being involved in the venture ecosystem to the extent that I am, that it feels like we're going through a little bit of a period right now where there needs to be a reset and a rethink of what good venture, like the craft of venture, you talked about it earlier, what the craft of venture looks like, in 2025, in 2030, et cetera, because otherwise what you end up with is non-deploying capital. And there is absolutely huge amounts of dry powder out there, right? But otherwise you end up with non-deploying into, or very few people deploying into very few companies. And because everyone's too scared of taking what otherwise would have been a normal bet. And this goes back to your kind of contrarian, the thinking behind how you approach each investment at Rank, right? So I'd love to get your thoughts on where the market is right now, Rajan. I know you think about this quite a lot, right? Because it certainly feels like we're in I mean, the last couple of years for sure, but even now it feels like we're in a bit of a strange territory.
Yeah, I mean, look, so first we have to accept that 2022 washed out a lot of money, by number of investors, right? So today we have far fewer funds with, 20, 30, 50 million, quick money, quick to deploy.
Yeah.
All
the Tiger style kind of like term sheet.
Not even that big, right?
Yeah.
A couple of guys or girls or
FOMO
whoever.
investors. Or
FOMO, chase the trend, all that sort of stuff.
Term sheet in 24 hours.
You'd also got to understand that most of the investor base, that the LPs into these funds, have also sort of gone wary of, fund managers that go out, raise money, throw the money out the door, and start running to raise the next fund and the next fund and the next fund, right?
All the while, no DPI.
No DPI, no visibility on the quality of the underlying deal flow. I mean, look, all the wrong things, right? And that's not to say that they won't do well, right? They may do well. I'm not judging that at all.
But LPs, on the other hand, are looking at it and saying, would I re-up today knowing what I know today, right?
Yeah, because I've invested in venture for the last 10 years or
and
whatever
I'm not
it might be.
seeing any cash coming back.
Yeah, exactly. So, I mean, I invest in funds, right? But I'm very, very careful about who I do it with, right? There are very select fund managers that I think are phenomenal, do a very honorable job, and are actually very considered about deploying their capital and helping those companies grow.
Yeah.
Is it fair to give a couple of examples? Or
I mean, it's up to you. Yeah.
Yeah. I mean, like
there's
one fund in the defense sector called MD1.
Yeah, they've been on the pod.
Awesome guys.
They've been
awesome guys.
Will and Ed have been on the pod.
Yeah, we're both LPs with them.
Yeah.
And in fact, I introduced their first deal to them.
Oh, amazing.
Yeah. Ankush is an investor in a fund called Twin Paths, right?
Yep. I know Twin Path as well. Yeah.
Phenomenal.
Great people.
Right.
Also,
great people. Just
good
people.
A couple of deals to me as well.
You support Superseed as well, I think. Both Mads and Dan have been on the podcast.
Yeah, I mean they're great guys. I've been involved in one business with them on the board.
Okay.
But not an investor.
Oh, okay. Right. Yeah.
Yeah. So if you look at the movement of wholesale capital, the university funds and the bigger ticket guys, they're not deploying so much in venture anymore, if at all, right? And why is that?
As LPs or
as LPs, right?
Yeah.
And why? Why is that, right? Well, first of all, they haven't seen the DPI, right? Yeah. Secondly, you have to look at the risk-free rate of return.
Yeah.
Right? When you start compounding the risk-free rate of return over the typical venture life cycle, right? The average DPI and the return you're getting on a risk-free rate of return, the spread's not that wide.
Someone told me yesterday, I don't have the report, but I think it was a British business bank. Sorry if I'm wrong about this, but I think British Business Bank reported average fund return as like 1.24x from, I don't know what vintage or whatever, but like that.
That's DPI, is it?
I'm not sure if that. I'm not even sure if that's cash out. Like, so I don't know if that's TVPI or MOIC or whatever, right? But irrespective, 1.24 is you're basically you're barely returning capital. I mean, actually, inflation adjusted, you're probably not. Right?
Yeah. And then if you look at how we approach our business, why do we not charge a management fee, right? As investors, it is, excuse my French, fucking painful to be diluted by 10 to 20% of your deployed capital before it's even been put to work. Before it's even been put to work, right? And then God knows the other, the things that I hear about. I won't name names, but some of the funds, the shit that they pull in terms of the fees that they stack on to try and get fees out of the portfolio company.
Oh, I mean, that's typical EIS behavior. We're gonna have an EIS investor on because he wants to refute some of these claims, but there's definitely very negative sentiment in the market with a lot of funds which essentially charge portfolio fees. They'll invest $1 million, 15% of that comes back out as fees or whatever the number is. But eye-watering amounts for sure.
Yeah, exactly. Whereas what we say, we believe in the companies we're investing in.
Yeah.
Right? We're putting our neck on the line. At least 20% of the SPV is us. Right? And we don't believe in bleeding the company along the way.
Yeah.
Go make your money, deploy it fully.
I mean, just to be clear, the most we might ask for, right, is for them to pay the SPV structuring costs.
Yeah.
But those are tiny, right?
Yeah, those are like what you can set up an SPV for up to 10K, I think. Like,
Yeah.
or even
I mean,
less.
shout out to Odin here. They're
Yes.
very, very good.
Very good.
Small investor in Odin.
Very
well
good.
done.
Very
Yes,
nice.
yes,
Yeah.
yeah. Good guys.
But just to kind of elaborate on what Rajan was talking about, we are hyper focused on DPI, right? Largely because it's our own money, right, that's going in, or a large part of it is. And frankly, we don't get to make money out of what we're doing until and unless there is DPI.
Until the company has a successful event.
And it really astounds me still, not just in this industry, but in private equity, the fund life cycles tend to be a little bit shorter and so on. So you tend to have that cash to cash a little bit quicker. But it astounds me that, people are still so, still kind of hang their hats on TVPI and MOIC to the extent that they do, right? We've all seen how valuations can change, like, with a snap of the fingers, right? What happened in 2022, what's maybe about to happen now.
Yeah,
right?
we're going to talk about that in a second.
We're old enough to remember 1999 and 2000, right? In 2001, like these things happen, and you cannot eat TVPI.
Yeah,
right. You can put food on the table with DPI, and that's why we're just hyper focused on that.
Yeah. So actually, let's continuation to that question I asked Rajan. So where is the market today, as I said, right? Like, especially when we think about that exuberance that we talked about in the late teens, early 20s, maybe in 99, 2000, as you mentioned, what do you think the lessons that both investors and founders need to internalize right now as we head into 2026? Like, what should they be thinking? And what were the lessons, I guess, that you guys learned as the market shifted, right? Like, so for me, for example, what we tell all of our founders, all the founders that we work with, is if you think your runway is 18 months, it's not. Like, it's going to need to last 24 months at the very least, right? Like, whatever it is, it's, add 50% to your runway, add 50% in terms of
the requirements.
The requirements for your runway, because ultimately it is taking longer to raise capital. It's harder to raise capital. There is less money going into fewer bets. There is as much money, but it's all going into fewer bets. This shakes out every time you look at any data that comes out of Carter or Crunchbase or anywhere else. Like, very clearly, money is concentrating in the US. Certainly, it's concentrating in mega rounds in these foundational models. Europe is a bit more diversified for sure, but still we're seeing that concentration. What I'm seeing again is like a lot of bio, health, med kind of very, very deep tech R&D driven bets being taken. But so going back to my question, what do you think founders and investors need to be thinking about, and really like just hammering home today about, what they should be thinking as they go into 26?
As a business founder and as an entrepreneur myself, right? And I think this applies to many other founders as well. Not some of the categories you mentioned, which like biotech, for example, where you have to keep investing.
Yeah, it's R&D. You're spending on exactly.
But for a large class of businesses, I think you need to have a plan to get to profitability, with the current capital at hand or with the current raise, right? And if that's not the case, if you're really going for a larger outcome where you think you're going to need, multiple rounds, 2-3 rounds to get to the size you need to get at.
Yeah.
I like to think about it in terms that actually a guy I used to work with in my hedge fund days used to call it, right? So when we'd analyze a business then, he would say, this is great. They're unprofitable right now, but they have a put option on profitability.
Yeah. So if they need to, they can get there.
They're spending right now on marketing, or they're spending right now on growth, or like Amazon for much of its
reinvested
lifetime,
all free cash
reinvesting profits into growth, right?
Yeah.
So, but at any one moment, if the funding markets dry up, if macro circumstances change, you have a put on profitability with a quick pivot, a few small changes or large changes, but within your own control, you can switch to a default live position. And I think that's super important, in current circumstances where, the world has been awash with money for the last 15 years, right?
And
that money
almost free money for a large portion.
For a large portion of the time, the growth of credit and the growth of asset values has far outstripped the growth of real money in the economy. And that creates a lot of volatility in these funding circumstances and in the funding environment. So you need to be prepared for a sudden change in that funding environment and be ready to move to profitability if that's what happens.
Yeah. Rajan, presumably you'd say something similar, but any other
lessons
that you think
I think it's a little bit more complex than that.
Okay.
Right? And that's probably even if the world blows up or it changes, this is why investors like us exist, right? It's not just if the world blows up, but you know what I mean, right? Like we're still stood there, right? We're ready.
Yeah.
And if I were to encapsulate what we really look for at that point in time is, can you honestly, hand on heart, say that because we work with companies which are dealing with enterprise clients.
Yeah,
right?
sure.
Can you, hand on heart, say that you have a North Star and some degree of timeline on reaching a world where you are delivering meaningful ROI to your customers, right? But in control of your margin during that process. Right?
So you're not simply you're essentially not unit economics negative. You are selling profitably, and so if your customers go through a downturn, they're not going to automatically switch you off because you are a nice to have rather than a must have.
Well, that's the second layer to the conversation.
Sure.
But the first layer is, are you delivering ROI, meaningful ROI, right?
Are you needed in this world?
Yeah.
I.e., and that could be either positive uplift in revenue or cash for the customer, or it could be a saving in time, or it could be efficiency. It could, like, the ROI could be measured in obviously many different ways, right? Yeah.
But then the margin conversation changes, right? That's the bit where, are you saying you'll be able to deliver that in 2 to 3 years' time, hoping that cloud compute costs don't change, right? Or, labor costs don't go up, or for any number
taxes
of reasons,
don't rise, whatever.
The tax is a separate conversation,
Sure.
but how much of that margin are you truly in control of, right? And I think those are the two strong, like, North Star points. I would say that really we have our eyes on.
Yeah, I mean, you're absolutely right, Rajan. Those are things we always look at. I guess it's kind of important, though, to get our founders ready, and we do talk about this a lot with our founders, of what happens if it takes longer to get from that position to a position of profitability than you think, right? That's where we stand, right? We stand behind our companies and our founders there.
Yeah, I've seen it.
And we've both, unfortunately or fortunately, been through enough times, both good times and bad times, to build up a pretty strong level of resilience, across the different businesses we've been involved with. And we know how difficult it is to build a business. We know that there will be bad times, and we do like to think that our founders think that we're there to back them when the times do become tough as well.
Yeah, I mean, I think, if I were to ask myself that same question, I think I'd certainly agree with you, Ankush, in have a plan that can pivot you to profitability should you need to, right? Like, if funding dries up, or if it's really tough to raise today, and you need to stretch things out for 3 months, can you switch off, to your point, marketing, or maybe you have to let some people go, but can you get yourself to a default alive position? I think is critical in any business at any time, right? Like, and we know this always as people who've run businesses, to your point, right? Like, you just don't know what is going to happen cyclically, and you need to have a plan that is anti-fragile, right? Like, I guess is probably the best way of putting it. I think the other thing that I guess when we're talking to founders, we are very, very not critical of, but try and make sure that they understand it's taking longer to raise. your chances of progression from seed to A and A to B is taking longer and longer. There are lots of companies stuck at B and C, not able to raise growth thereafter. Do they have exit pathways? Maybe, maybe not. M&A and IPO activity up until sort of second half this year has not been great. We are seeing a little of that unlock. So when that unlocks, you get liquidity coming back. So there's a bit more appetite. There's also potential, M&A opportunities that come out of that, right? So then you have a pathway possibly to someone acquiring you if things do go bad. But I think, those are all the optimistic, like if we can get there kind of plans, right? Our advice is always, you got to be planning that your runway is going to have to last you longer than you thought it was. Downgrade your sales estimates by 25, 50%, because ultimately in a market, certainly at the moment in the market that we're seeing in 25 and into 26, and especially when you're dealing with enterprise, like those cycles are already long, right? We all know they take 6 to 12 months. They are taking nine to 18 months, right? Like it is taking longer and longer. People are sitting on their hands. Budgets are not being spent or are being frozen, et cetera, et cetera. So, and it's a really hard one, I think, for both founders and, venture investors to get their heads around, because obviously venture has always been on this sort of hyper growth kind of, 3x, 3x, 2x, 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 like how do you grow exponentially? But in a tough market, unless you're a Lovable or a Cursor or whatever, right? Like, yes, those business, and those are consumer businesses, so it's different in enterprise anyway. But if you are servicing enterprise customers, for sure, like my only piece of advice is it's going to take you longer to close a deal than you thought it was, and there are probably going to be fewer deals out there than you thought there were, because
and moving from pilot to full contract or full rollout or whatever it might be always takes longer than you think.
Always takes longer, is tougher, and like a design partner is not the same as a paying customer. Like those are two very different things. So sadly, I have to be the CFO in the room. You guys have to be the trusted board guys, either directors or observers, But I think that is one of the things that I know about both of you that I think is appreciated by the founders that you work with, because you are hands-on even at board level, right? So you get into the numbers, you get into the sales conversations, you get into opening the doors to the right potential customers or the right events or the right whatever it is.
Yeah,
right?
or even bringing the right person on board.
Hiring the right people. Yeah, absolutely. And I guess like moving on to that, I guess, right? So what is it that you guys bring to the board with the companies you work with, and how do you think about like intentions, actions, and consequences when you're working with founders? I know this is...
You're stealing my lines now.
Yeah, absolutely. I listen occasionally.
Look, and actually that's probably the thing that sits in the middle of all of it, right? It's you're working with a group of people at any one point in time. There's always going to be actions that are taken that have a less than desirable outcome. And you have to sit around the table and discuss and dissect, right? First of all, sorry, go on.
I was gonna say, do you see that happening intra-board, or like as in amongst the board members, or is it founders to board or board to like where do you see that happening most?
I think the accountability usually comes to light at board, right? Sure. So founders or team to the board, and then you look and you say, right. So I try to observe as much as I possibly can, right? And my first sort of instinct is, okay, are these people united in what they're presenting to the board, or is there a blame culture, right? The minute you see blame culture, there's a weakness, right? So you have to address that first, right? Once you've removed the blame culture, you say, okay, right, you've had an outcome that you're not so happy with. Can I ask, what was the action that led to that? And it's usually something, someone's made a decision.
Yeah, surface level.
Right. Yeah. Someone's made a decision and they've just decided to run with it. And and for whatever reason they thought it was the right course of action. Right? You say, okay, what was your intention behind that action? Why did you take that course of action? Usually the other people are pissed off because they feel they should have been consulted before that action was taken, right? So you say, well, why did you choose to do it this way, this time, right? And if the answer is, my job description is, I am responsible for this. I can do what I want. You kind of go, well, all right, mate, that's ego, right? Or if it's, I was in a corner, I was really, the person put me on the spot, so I just went with it, right? That's ego in a different format, right? Like you traded from a position of
submission,
fear, right? So you try and highlight, like, where did that come from? Yeah. So then bring that conversation back and get everyone united on the intentions first. Make sure that everyone is,
which goes back to your North Star point, right?
Yeah.
Like everyone pulling in the same
correct,
direction.
right?
Yeah.
So everyone's holding hands and they're dancing around in a circle
Kumbaya,
saying, kumbaya, right? Yeah, we all want the same thing. Or, that's our intention. Then you can start to go back to action and say, right, in the future, right? What is the process, or how do we make sure that this doesn't happen again? Or is there any action that can be taken to remedy this? And most importantly, at that point, the action, I would say 9 times out of 10, as dangerous as it is, I'm normally the one that sticks my neck out and says, okay, how do I get involved in that action to help you out? Right? It may not be the right thing, so you've got to know when to back off as well.
Yeah.
But usually, to get the right action put into place, it does need a bit of hand-holding and a bit of help.
So it's interesting because I had Fred Destin on the podcast like last year. I think it's last year. Geez, I mean, like this year has really run away with me. And he talked a lot about what being a good board member is all about.
I listened to that podcast. It was a great podcast.
Yeah. I mean, like it really was, just from the perspective of hearing his thoughts on that, because like I know this, having sat on a number of boards, having been an observer on a number of boards, and obviously working with founders, you can see who is an engaged board member, someone who's interested in what is happening in the business, who is a performative board member, right? Someone who is there to basically, he's either a rubber stamp of the investor, or he's there to protect their interests. And some of the best board members, like investor board members, investor directors that I've worked with, like will literally sit in the room and say, look, I don't need a markup. Like, why don't you do this? Why don't you do that? Like, don't go out and raise in this way. Maybe we try it this way, or let's focus on getting the revenue. Let's skip the Series A, or whatever it is, right? Like we like don't worry about what it is that we need as investors. Think about what you need as a company and as founders. And the impression I get, and again, not even the impression, having again worked with both of you in various ways over the years, I think it's worth saying. By the way, sorry, we didn't mention this early doors, but Ankush and I have known each other since we were 7, so we've known each other a pretty long time. But the impression that I think the audience will get, but certainly that I know to be true, is that, as I said earlier, you guys are really hands-on with the companies that you work with, even when you're sitting on the board.
When
appropriate.
When the companies need it.
When appropriate,
A company like Starship Technologies, they know what they're doing, right? Yeah. They've got the North Star, we don't need to be hands-on.
Yeah, no, but because you invest across stages, like often with especially younger companies, like they do need a little bit of guidance.
They do.
And
Rajan and I, we like I said earlier, we have very similar values and a very similar sense of risk reward, but we also have very different styles, which I think makes us very good.
Very true.
At working together.
That is also very true.
It's true, but it makes us very good at working together.
Yeah,
we have different skill sets and complementary in many ways. But we have that absolute trust in each other. So, for example, Rajan was talking just now about team dynamics, right? And I've seen this in person, him going in and kind of helping a team to work better together. And literally I've seen in real time the blame culture of a company being reduced through his interventions, right? I would tend to perhaps take a more on many of the venture boards or many of the kind of founder-led company boards that I sit on, I would tend to take a little bit more of I guess, a strategic approach, where I see the view or I see the role of a board member as asking really thoughtful questions, trying to get the founders, the managers, the management team to really think about what they have in front of them, whether they might be underestimating the size of the opportunity, underestimating the size of the potential obstacles on the way. Maybe there's stuff that they're not seeing.
Yeah.
As entrepreneurs and investors across many different sectors and many different companies, we are privileged to have seen hundreds of different situations.
Yeah.
And maybe there's another situation with some similarities to this one.
It's pattern recognition.
Yeah,
right? Yeah,
but it's not even just pattern recognition, because we might be recognizing the wrong pattern. The fact is that the founders, the people running the business day to day, know it way better than we ever will, right? So it's more a case of showing, look, here is a situation that looks kind of similar. This is what happened in that situation. Maybe there's something we can learn from it.
Yeah.
Why don't we have a discussion about it?
Yeah.
Right? Rather than trying to force a particular prescriptive solution down someone's throat.
100%. And again, this is, I think, a lot of what came out with that conversation with Fred was exactly that, right? Like, it's knowing when to speak up and what to speak up about, and not to speak up just for the sake of
absolutely.
saying something.
I'm very happy, in some of the companies that I'm even more involved with, I'm very happy to just be quiet for an entire board meeting and just observe and listen and maybe make 2 comments, right? But there's always a bit of thought that has to go into one's role in that particular company and that particular board meeting.
Yeah.
And there are companies where I would chair a board where I will hardly say anything. That's where I trust the management, I trust the CEO, I trust the other board members, and I hired them for a reason, right? Whereas in other situations, maybe a bit more guidance is needed.
Yeah. No, I think absolutely. I think absolutely, right? Like, every company is different. It's something that we talk about all the time internally in my business, but also externally when we're talking to kind of potential clients. We always get asked, like, what is the typical thing you guys do as CFOs when you come into business? And the first thing I said, well, there is nothing typical, because every single business we work with is completely different. Like, each one of them has a different set of priorities, a different set of outcomes that they're looking for, a different set of issues that they've got to face today, right? And I think as board members, it's exactly the same. And also bearing in mind, to your point, right, you're on a specific board in a specific company, at most you're meeting for 2-3 hours once a month, like at most, right? And often it might be a couple of hours a quarter. Obviously you're having conversations outside of that, but at the board meeting, it's a very concentrated piece of time. So maybe, Rajan, to ask you this question, what do you expect coming into a board meeting, and what do the best founders do to show you that they know what they're doing? Like, how do you kind of assess whether a founder has come in prepared or not?
Well, funnily enough, about 6 or 7 years ago, a prolific VC I was with, we were talking about board meetings, and he said, listen, I don't really go to many board meetings. He's a board member, but he doesn't really go to many, right? Which probably doesn't sound that professional.
No.
All right. But I said, well, that doesn't sound right. And he said, no, what you have to understand is that 90% of the work that is done at a board meeting
is done before.
Yeah,
exactly. Absolutely.
Yeah.
When you work with founders who understand that, that's the most beautiful thing, right?
Yeah.
They'll prepare you before you go into the board meeting.
Yeah.
No surprises.
Right? No surprises, right? What you've discussed outside of the board meeting is already considered and accommodated for at the board meeting, right? And so when you go into the board meeting, given I'd say probably half of the board members there are rubber stamping anyway, right? It's an exercise, it's a formality rather than a drawn out
Yeah,
process.
you're there to get things passed, not to debate them.
Yeah.
I mean, you will discuss and debate them potentially, but the discussion and the debate is a concatenated version of what's happened outside.
No, I'd actually say it's slightly different. In the best board meetings, the discussion and the debate is about what next.
What next?
It's
Yeah,
not
exactly.
It's not about what just happened.
Yeah.
Right. It's about okay.
How do we now move forward?
What does it look
Yeah.
like 2 years from now, 3
Yeah,
years from now?
sure.
You know what I mean?
Yeah.
Yeah.
Yeah, 100%. Listen, guys, I want to move to the last couple of questions that we ask everyone that comes on the podcast. So firstly, what is one thing that you have a contrarian conviction on from any area of life, whether that's work, politics, socially, or at home? Rajan, let's start with you.
I was hoping you'd start with Ankush. Interesting. I was asked a different question yesterday at dinner.
Okay. You're going to answer the different question. Yeah.
So the question was, what would your parents say about you
Okay, nice.
if they were sat in the room right now? And the answer I gave was that they would call me unorthodox yet effective. And I think that translates across everything in life, right? And I spend a lot of time with my children, as does Ankush. We're very fortunate.
With his children, presumably.
With his
Not
own
yours.
children. Yeah.
We do hang out sometimes
Yeah,
together as well.
But in that time, it's what we look at is what's going on in society at the moment. So education is probably the biggest point. And our education system is still sitting on whatever it was 100 years ago, built for making factory workers and employees.
Yep.
Right. Some lucky people broke out of that and became entrepreneurs and creators. That's decreasing over time, right? And
certainly in this country it is.
yeah, and the reason for that is twofold. First of all, the education system is still stuck on,
Agreed. Yeah.
right? With the exception of, Sophia High School, for instance, a company that I love and obviously an investor in.
We're both investors.
Yeah, we're investors in, that take a radically different approach, which is proving out to be extremely effective as well. I'd like to zoom out on that, and my approach is, so society is being programmed to be consumers, particularly in the UK, right?
Or in the West more generally.
In the West more generally.
Yeah, sure.
Right. So how do we work against that? How do we show our children, and I'd love for all children to open their minds to this, which is fun. This is very timely. Last night, my wife asked my son, Aman, how come your grades have improved so much? Right? And this is the unorthodox bit, which I'll probably get lynched for. But about 7 or 8 months ago, I was cooking in the kitchen, and I said to my son, come and help me. Oh, no, Dad, no. So, all right. So, okay, should we do some exercise together? No, Dad, no. I'm like, all right. Mom, can I play Xbox? I removed the Xbox. The Xbox no longer exists. There were some tears, and it was whatever. So I then got a bucket and window cleaning equipment. I handed it to him. I said, in my apartment, we have floor-to-ceiling glass. So I said, go around and clean all the windows. He cried a bit, but then he got on with it. That evening, every time he came into the lounge, he would sit there and just stare out the windows, smiling.
Job well done.
Right?
Yeah.
So I asked him the question. I said, if you had been playing the Xbox for 3, 4, 5 hours, after you'd finished playing, would you be sitting there smiling like you are now? Right? And he said, no way, Dad. That feeling in your heart that you've got right now of having done something with your own hands, that joy that you have, and you can still look at it. So last night, when my wife asked him, how come your grades have improved so much? He said, Mum, don't tell Dad. Don't tell Dad. But getting rid of the Xbox and getting me to clean the windows was probably one of the best things he's ever done. So that's my contrarian.
Yeah, I was going to say, I'm not sure how contrarian it is to get, for parents to get rid of their... I mean, it's not something that happens, but...
No, I think it's more the method.
Yeah. I think
the method was
I think the method was definitely contrarian. Ankush, how about you?
So I think we're pretty contrarian with our kids as well, to be honest. I am, for sure. You know, I'm a big believer in you know, seeing the way things are done in the real world, not just in the classroom.
You took them out for a while last year.
Exactly. So we spent the last year traveling around Asia, actually, with the kids and kind of going to visit Xbox Park, which is an amazing robotics accelerator in Shenzhen, and, you know, going to see an EV infrastructure business in India. And actually just a few weeks ago, we did a field trip, Rank Ventures field trip to Starship Technologies and the Amazon logistics distribution warehouse and so on. So I'm a big believer in all that stuff with the kids. But actually, what I'm going to say in terms of a contrarian view actually is something in the markets, right? So the last, let's call it 5 years, 10 years more, it's all about big tech, Mag 7, AI, all of this stuff. And I have no doubt that you know, AI and technology in these formats is gonna continue to dominate global growth and the way the world is developing, right? And that's why we invest in it, right? But all of these developments, all of these advances, all of this growth needs atoms. It needs materials. It needs stuff to build it and power it, right? When I look at investable opportunities, I look at things like this is not going to be perhaps very ESG friendly or politically correct or whatever, but I look at things like oil and gas services.
Yeah, sure.
Right? You know, all of these data centers, you know, people are talking so much now about what's going to power them, right? What are the constraints? Energy and real estate and you know, water and things like that. Well, uranium is looking pretty undervalued at the moment.
Nuclear power plants for the win.
Yeah, well, I mean, nuclear power plants themselves take years and years to develop, right?
We've just had one announced in Wales, I think, which might take 10 years.
But you know, if you look at the supply demand balance of uranium and the number of mines there are out there and how long it's going to take for new mines to come on stream, it's looking like a pretty good risk reward right now. Same with oil and gas services. You know, there are fleets of offshore drilling vehicles. Offshore workboats, for example, Tidewater being an example, right? Which can be bought. You know, as a company, you can buy it for a third of replacement cost, right? And there's a massive historic undersupply of these things. So, you know, who was it? It was Ronald Cohen, the founder of Apex, who wrote that book, Second Bounce of the Ball, right?
Haven't read it. Okay.
Where he talks about the art of investing is, you know, not just looking at where the ball is going to bounce, but where it's going to bounce next, the second bounce of the ball, right?
Got it.
So we've got, you know, all of these AI data centers, you know, massive investments going ahead. Everyone knows it's going to need more energy to power it, right? You can buy utilities, or you can think about, well, what does that mean for energy 5 years from now? What does that mean in terms of what we're extracting out of the ground? What does that mean in terms of nuclear power and uranium and things like that? So those are the kinds of things I think about, geeky as I am.
No, I love that. By the way, this is not investment advice. Do your own research, but
no, please don't buy uranium. Don't buy oil and gas services. Leave it for us, please.
Yeah, they want first bite of the apple, if not second bounce of the ball. But no, look, I mean, I think this whole atoms over bits argument is one that, you know, in the last 5-6 years has definitely.
So I just want to stop. It's not atoms over bits, just to be clear, right? It's like, you know, bits are here. They're going to get bigger.
But atoms are.
It's relative
well.
pricing. It's relative pricing.
Okay,
that's what it is.
Okay.
It's risk reward.
Yeah. I mean, well, I would say it's not just relative pricing, but it's also I think there was an assumption at one point that, you know, manufacturing, like businesses that made stuff or built stuff or whatever, were not sexy enough, not interesting enough. You know, everyone was piled into software. Obviously, we've seen a massive shift in that, you know, whether it's defense tech, whether it's space tech, whether it's data centers, et cetera, whether it's chips. And I think there is, you know, there is, if not a realization, people have come back to that, exactly that thinking that you still need stuff to build stuff, and you still need stuff that drives, you know, the other innovation forward. So yeah, I think I'm not sure how contrarian it is, but you know, at the same time, I think desperately needed. So I want to finish off with one final question, and this is to get to know the real news, or for the audience certainly to get to know the real news, the real use, because I think I probably have a good idea. But what is something that makes you emotional, Ankush, if you could?
Makes me emotional. Wow. I love spending time with my kids. And recently, it's given me a lot of joy, a lot of emotion, to listen to heavy metal with my kids together and see how into it they get as well. Because it was something that brought me a lot of joy when I was a kid.
I remember that a lot. I think I still got some of the pictures. But that is beautiful. And I think music is one of these things that shared connection, especially with children. It like, even in our family, like the one thing that stops the argument in the car is the music going on and everyone kind of being together. I think, but I think that's lovely. Rajan, how about you? And don't say Phoenix.
I was going to say Phoenix.
You can say Phoenix. That's absolutely fine.
I'll be honest, he was a bit unwell a few weeks ago. One of my friends accidentally gave him onions.
What breed is he? Just so the audience knows.
He's a toy Pomeranian. He's a toy Pomeranian.
Toy Pomeranian.
He's a lilac toy Pomeranian.
Okay.
Who wears a bow tie. But yeah, but he was very sick, and I had to rush him to the vets at about 1 o'clock in the morning. And don't tell anyone, but I shed a tear.
Okay.
As the vet said, "You're lucky you brought him here. He may not have survived it." But as anyone who knows me knows that guy is always by my side.
Always, yeah.
Apart from here. But there's I think it's very similar to Ankush. It's time with the children.
Yeah.
And we go. So every summer we go on road trips through Europe. Every time we go, now when we go, we pick the first destination, and after that the kids pick the next stop. I think there's a lot of emotion in that, ranging from the joy of driving with the roof down and the sun out, through to the feigned joy when my daughters saved £20 by booking a hotel that's probably we shouldn't be staying in.
I've seen some of the hotels you stayed at. I will forbear to comment. But no, look, I think, and it's really interesting because, again, working in venture, often a lot of people in venture don't yet have kids, or don't have kids as grown up as either of yours are, as grown up as mine are. And, then you hear stuff like 996 and grinding, and, you got to be hustling all the time and so on. And you're just like, well, I get that building something consequential is tough, and I get that building something consequential is going to take time and energy, and you are going to have to make sacrifices. But I think the last sacrifice you ever want to make is, to your family, to your wife, to your kids, or to your partner.
But Aarish, you build around it as well. Like, let me give you the example of when we were traveling around Asia for the year, right? I was traveling with the kids. Obviously, I wanted to make the best of that time, but I would regularly be working from 9 p.m. after dinner, while the kids were going to bed, up till 1, 2 a.m. Right? You've got to do what you got to do. Yeah. But make sure that the time with the family is there as well.
Yeah, I think exactly that. For those of you that have kids, I'm sure we're not telling you anything that you don't already know. And for those of you that don't yet have kids, look, birth rates are dropping. Go out there, support your country.
Be contrarian.
Be contrarian. Fly against the trend. I just read somewhere that Italy is down to 1.3 in terms of birth rate, so it's really,
wow.
Really coming down. Europe is trending that direction, as we all know. But listen, it's been absolutely fantastic having you guys on the podcast. Finally, really glad that we could do this. For the audience, where are you online? Are you on LinkedIn? Are you on Twitter? Where's the best, or X? Sorry, where's the best place for people to find you on the internet?
LinkedIn. Look it up, Ankush Shah.
Okay.
Yeah, LinkedIn.
Amazing. Thank you guys. Really appreciate your time. It's been an absolute pleasure having you.
Thank you. And thanks for the thoughtful questions.